Thanks, everyone. So I'm going to go pretty quickly through the project, through the MIMOSA project, and sort of review what it is that we do, how it is relevant to microfinance and financial inclusion in rural areas, and then we can just spend the rest of the time with questions and discussions. So let me just maybe as a start give a basic example of how markets work and why we need a tool like MIMOSA. So consider if microfinance or actually finance generally, and specifically if credit, were to work exactly the way consumer products work. So let's say you're in the market for an iPhone. You go to a store and you choose your iPhone. The clerk looks at you and says, "Well, Mr. Daniel, I would love to sell you this iPhone, but I can't because I don't think you're a good customer." And the thing about it is that it seems like a strange kind of scenario, but that's exactly how credit markets work. And the reason it's important is that the decision point on whether to transact, whether to purchase a good, or in this case, whether to take out a loan, doesn't really rest on the client at all. It mainly rests on the lender, on the supplier. And so the basic model that we use in economics to make sure that markets are at equilibrium, which is balancing supply and demand, which pretty much happens naturally, doesn't quite work in credit, because if suppliers want to supply more credit, borrowers will take it, and there's examples of this time and time again, and this is why it's really incumbent upon lenders, whether microfinance or otherwise, to be always conscious about whether they're meeting the sustainable demand in the market. Maybe they're not meeting enough, or maybe they're actually meeting too much and they're actually saturating the market with credit. And that'll mean either overindebtedness for clients or suffering for the lenders down the road, or both. All right. So the basic model that supports other areas doesn't quite work in microfinance, and that's why we need a tool like MIMOSA. I'm going to skip this and maybe give you an example of one area that we look at before there was MIMOSA. One of the major components that was used for this was multiple borrowing. So one thing that we've done in MIMOSA is collected a lot of data from a lot of different sources, and this is a comparison of multiple borrowing rates in quite a significant number of markets. We actually have more than this, but it gives you an idea of the distribution of multiple borrowing. It really follows a pretty wide, there's quite wide variation between markets. And this, by the way, is just clients who have 3 or more loans. You could look at different other indicators for multiple borrowing, but this is one good way of looking at it. And historically, this has been also the threshold of markets that have gone into crisis, such as Bosnia or Morocco, that clients holding 3 or more loans tend to be much more likely to default than clients holding 2 or fewer. So the thing, when you look at these markets, you notice something interesting. These 3 marked in red all went through crisis, and the particular data here is taken at the market peaks for each of these. And what you see is, on the one end of the scale, you have Bosnia, which had very high levels of multiple borrowing. On the other end of the scale, you have Morocco, which has really quite moderate, levels of multiple borrowing. And in between, you have markets that have more. You even have Mexico, which has a lot more multiple borrowing than any other market, and yet has not really had a crisis. And nor does there seem to be a crisis on the horizon. And so multiple borrowing alone doesn't really tell you everything. It's useful, of course, but it's only part of the story. And this is why we're using MIMOSA as a kind of a means to see the fuller picture. One way to look at it is that there's a natural correlation between the depth of loan penetration in the country, how many adults have a loan, 1 or more loans, or how many adults are active borrowers, and what is the average level of multiple borrowing. This is, again, one of the significant data sets that we have, which is collected from 5 different credit bureaus over a period of time, and the data is moreover at a regional level, at a provincial level. So it gives us quite a fair bit of depth. And what you see is that as penetration increases, as a greater proportion of adults are borrowers, so does multiple borrowing itself. So a larger number of adults also have multiple loans. And the interesting thing is, you would think that'd be possible to have a market like this, in the bottom right of the chart, meaning a market where penetration is high and a lot of people have a loan, but relatively few have multiple loans. In this data set, there really no market falls into this. There are some that are closer than others. But what it does tell us that markets don't naturally get to the state. And the reason being is that normally the way penetration increases is through competition. And it is also the case that in competitive markets, you tend to also see higher multiple borrowing. You also tend to see growth in loan sizes and other factors. And so this is a theoretical possibility. It might occur in some markets that might be non-competitive but have high state actors, for example, in Thailand or Vietnam, where there's not a large number of lenders, but the few that are there do reach a lot of people. But in competitive markets, you don't really see this. And so again, in looking at multiple borrowing and looking at penetration, you're seeing a slightly bigger picture. Going into MIMOSA itself, MIMOSA is really based on 3 things. One, it's a measure of penetration, which is what I just went over. How many adults are active borrowers? Second is a measure of capacity, meaning how many adults ought to be borrowers, given the nature of the market. And that generates the MIMOSA score, the difference between these two. That score is set within the context of a whole suite of indicators that may act as additional risks or potential mitigants that would allow a market to be at a greater or lower level of penetration than one would normally expect. Things like regulation, nature of competition, so on and so on. So we'll go through those in a second. The way we calculate penetration is we look at multiple data sets. If you go on the MIMOSA website, mimosaindex.org, and you look up the spreadsheet that has about 90 countries with scores, most of the scores are marked as provisional. And that means that the scores are just drawn from Findex, which is a survey done every 3 years by the World Bank. And we basically don't, we take it as is without really validating it. And as a survey, it can sometimes be off quite substantially from reality. In the markets where we have in-depth studies, and so far we've done 7 of those, we take 2 additional data sets. One is a whole mix of what we call supply-side data, which can come from the central bank, it can come from the local microfinance association, a credit bureau, whatever happens to be available. And then we also do a small field survey as a kind of final check. And really, we triangulate between these 3 sources to try to assess, okay, what is the actual level of penetration? And so there's quite a lot of effort goes into this. And to my knowledge, there's not another source that can tell you this information outside of MIMOSA. So for that alone, it's, I think, quite useful. The second one is a look at capacity. How much would we expect given the level of the nature of the market? So capacity, if you look at sort of a distribution of markets by their level of development, in this case using the Human Development Index, you see an interesting a pretty strong pattern, which is that as countries are more developed, they also tend to have higher level of borrowing or higher level of penetration. Within any particular level of development, there's a wide range. But the further away you get from that sort of median, the more likely you are to be an outlier, and particularly in the upper end, you're more likely to be a saturated market with significantly high risks. So that's really the basic approach. It's not an economic view of capacity in terms of how much credit can a market absorb, but it's more of what is normal for a market. Our model is actually more than just that one indicator. We look at a couple of others, but those three generate our expected level of penetration. We compare the actual level to the expected, to the capacity, and that drives an MIMOSA score, which is numbered from 1 to 6, 1 being underserved, up through 6 being highly saturated. And it's fairly straightforward. It's easy to follow, which is why we do it this way. But it doesn't necessarily mean that once a market gets a certain score, it's necessarily a problem. Right? There are other things to look at. So by the way, here you can see kind of a distribution of scores once we run them against HDI. And you can see the high saturated markets being at the top end, but not necessarily. There's a fair bit of mixing as well. One last thing on the score. We went back in time, tried to produce a score for a number of markets that had gone through crisis. We unfortunately weren't able to get the data for Bosnia, but for the other three we have. And this is, had we run MIMOSA scores at the time, this is what they would have been. And it's kind of in some ways interesting to see that both Nicaragua and Andhra Pradesh would have scored at the very highest level of saturation, although Morocco would not have. And we can leave that discussion for another time, why Morocco doesn't fit in that profile. But even so, I think it is strongly suggestive that the score is an important set of information if you're looking to see how likely a market is to go into crisis, for example. Now, the part that's maybe most relevant to rural outreach is the fact that we developed the score also at the provincial level. So for every country where we have an in-depth study, Cambodia being one of those, we actually score each province. We calculate the sort of expected level of penetration in that province, the actual level of penetration, and we generate the score. And so that way you can get a real sense of how different parts of the country are distributed in terms of saturation. So particularly we have regions that are highly urban. They might look quite different. In this case, for example, that little green dot is the city of Phnom Penh in Cambodia. And Phnom Penh is actually, interestingly enough, somewhat underserved or certainly not saturated in the way the rural parts of the country are. So Cambodia is in some sense an inverse market. Usually you see the opposite pattern. But this is one way you can if you're looking to assess level of saturation in rural areas, this is a good way to get started. Understandably, a province may also include cities, but even so, usually you have pretty significant differences between provinces, and that can be a useful clue. By way of an example, I didn't put this up here, but if you were to look at a country like Senegal, you would see the exact opposite picture, which is that the city of Dakar is heavily penetrated. It's rated as a 4 on our scale, whereas the rest of the country, which is mostly rural, is either normal or underserved. It's rated anywhere from a 1 up to a 3 in some cases, and that's kind of consistent with what local market observers see as well. But this is a good way to kind of get information. The last part of MIMOSA, which I mentioned earlier, is this set of indicators that serve as risks and mitigants. This is an example for Peru. And so if you were to look at any of our reports, you would see this type of output in each report. And it basically scores different elements that are relevant to saturation and to over-indebtedness, and scores them on a scale of, green, gray, or red, basically a mitigant, neutral, or a high risk. And so what you see in the case of Peru, for example, it is a country that's saturated. It's scored as a 6, but most of the other indicators are actually quite solid, and so it's an indication that the market may be saturated but still sustainable. We can provide distribution between different countries, so you can look at summary scores across different countries, and that gives you an idea of what those look like. And we also provide expectations of future growth based on what the institutions themselves have been either reporting to. This is drawn from a mixed market survey that's usually done, once a year or once every 6 months, and they ask MFIs how fast do they expect to grow in the next 12 months. So this is usually where it comes from. Sometimes we'll do the survey ourselves. But anyway, you can see, for example, in Peru, even though the market is saturated, it's also not really growing. And so hence the risk is mitigated. In terms of the project itself, so far we have 7 reports available for the countries listed here. We really are hoping to expand to at least 20 markets. And the reports themselves are by subscription. We don't really have much grant funding, and so we rely on mostly investors and DFIs to subscribe to our reports. The reports themselves are they're available to locally based institutions. So, for example, if you're in Senegal and you're an MFI in Senegal, that report is available to you for free, and we distribute them through the associations. But for actors that are based outside of the country, the reports are by subscription.